I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, equity, and real estate. Let's get straight to those burning issues in private markets. From JP Morgan to Hudsons Bay, everyone seems to want to go private these days. Next, we take a look at what makes a retail startup successful at a time of Amazonian pressures. And one of the hottest areas in private markets has been direct lending. We speak with one of the biggest investors in the field, Randy Schwimmer of Churchill. So let's get into some of these burning issues. With me, I'm so glad to say, is Bloomberg's Sonali Basak, Crystal T, and Catherine Doherty. Let's start with Sonali. Hudsons Bay announced that it was being taken private for $1.45 billion. Why did it take this step?
Well, think about it. Hudsons Bay operates in a universe where it's really a challenged environment. That's retail, where you have competitors that are selling online, whereas Hudsons Bay also has all of this real estate to contend with. Can you imagine, Lisa, owning Lord & Taylor's, selling Lord & Taylor's, and still being responsible for the lease obligations, even when you don't own the brand anymore?
But why private?
So being private will allow them, in theory, to invest more, get out of the public view, spend a little more money on the growth initiatives, whereas they're not so beholden to that more than $300 million cost-saving initiative that they would have had in public markets. And remember, like I said, with the lease obligations alone, they have to be paying for. How do you get that cost saving when you also need to invest in that digital growth that you need that customers want?
All right, well, Hudsons Bay isn't alone in wanting to go private. Take a listen to what Jamie Dimon of JP Morgan recently had to say.
I would go private if I could. If, you know, like I think being a public company has real negative downsides to it, and so it shouldn't be that way. You know, it takes away the ability of the public to invest in companies, right? And you know, it takes away because they can't invest in some of these other vehicles. So I think it should be looked at very, very, very carefully, and that we should have a public policy debate around how do we want public companies to be governed? Do we want more or less? Because this trend has been going on now for a long time.
All right, that brings me to Crystal, and it's not just JP Morgan and Hudsons Bay. GNC also potentially looking to go private, according to a recent story. Meanwhile, you've got the total transaction size of public to private deals so far at its highest level in 6 years. So why so much interest right now in going private?
So a lot of the take-private transactions we're seeing are actually initiated by private equities. The reality is that there are a lot of dry powder in the private equity space. A lot of the money that's raised in early 2010, they have to either be invested or be returned to the LPs. And that's the last thing, you know, private equity firms want to do. So they're really looking for opportunities.
So why wouldn't private equity firms just buy the companies outright?
Well, for these companies that are already in the market, they can, you know, some of them can argue that it's somewhat undervalued, but the other reason for it is, you know, you buy a vehicle and you build the assets surrounding it. So it's pretty much like a buy and build strategy, because a lot of the companies have been tossed around, like private equity, a lot of the value has been extracted. You cannot really do a financial engineering model anymore. So the private equity actually have to come with something to offer.
And we are seeing bigger and bigger deals, which might be a reason or sort of one explanation for where private equity is putting that money. Are you expecting this to continue with an increase in these deals?
It's definitely something that has been discussed. When we talk to our sources, investors, bankers, they're actually talking about take privates. But the other reason I would say, you know, it's looking at WeWork. There's a lot of scrutiny for public companies. So, you know, it may be a good time to, you know, stay out of the private eye, not be under the microscope, and, you know, do what you have to do for growth and do what you have to do to take a company to the next step.
So Crystal raises a really good point of just how much money there is in private markets and what it's doing, which brings us to Catherine, who's been looking at the underlying creditworthiness of some of these companies, specifically within the leveraged loan market, signs of stress. Please explain.
Yes, that's right, Lisa. We've seen a ton of volatility recently. Bloomberg data shows that over $40 billion worth of levered loans have dropped over 10% of their value in the last 3 months. And this is specific to credits that were already risky, but the real concerning thing is we've seen more and more of them pop up, and they have been coming at a rapid pace and losing sometimes 40, 50% of their value seemingly overnight. So we're looking at those signs of stress and also gauging how the market is reacting. Some are fleeing these riskier credits, but they're also trying to find opportunities, searching for yield. So we're really just seeing a balancing act here in terms of how these situations are going to play out and how these lenders are going to change their strategy moving forward.
So, Catherine, how much of this is a market-specific issue with just flows affecting the price drops, and how much is a fundamental credit deterioration issue?
I would not call this an apocalypse by any means. Investors that I talk to are careful to note that a lot of these are specific to companies that already had issues. But again, what we are seeing is that more of them are popping up, and there's getting to be constraints placed also on where they're lending. We've also seen Fitch today just raised their default projection for loans. So we're going to continue to see that. If we see more defaults, some of these numbers that are coming in are starting to reflect data that was coming in 2009. So we will see how it continues.
Thank you so much to Catherine and all of our reporters. That brings us to my guest in this late stage economy. What makes a smaller business successful? David Bell is president and co-founder of Idea Farm Ventures. He was an early seed investor in Harry's, Bonobos, Jet.com, and Warby Parker. David, what makes a smaller company successful in this environment?
So I think first and foremost, you fundamentally have to have a really great product that really focuses on a pain point that resonates with people. And I think building around that, particularly in the digital economy, sort of a minimal viable audience of people who kind of express that pain point and give you...
Wait, back up. Pain point. What are we talking about here?
So, why are my razors so expensive? Why is it costing me $500 to buy a pair of glasses, the same price as an iPhone? Why is there so much single-use plastic going into the ocean? So things that we experience in our everyday lives that just kind of bother us, and now entrepreneurs have the ability to say, hey, I'm going to change that even if I had no prior experience in the sector.
So as you just heard, we were talking about an increasing number of companies going private from public. From your vantage point, how big of an advantage is it to be private when you're a startup, particularly in retail, or not startup, but even in a later stage?
Yeah, so I think there's really three core advantages. One is that you're shielded a little bit from sort of unwanted or unhelpful scrutiny. Second, you're not really under the pump to keep delivering results in a very quick fashion. And I think third, you can really focus on that core segment, be laser focused on the customers that really matter, and do that without people sort of looking over your shoulder.
So you go around looking at new ideas, right? So what's going to be the next Jets.com or Bonobos?
Well, I think it's somewhat hard to say, but I think the principle that we can kind of leverage is it's going to be something that really matters to people around really three pieces. It's going to be fundamentally better value. So, Warby gave us glasses for $95 when we used to pay $300 or $400. It's going to be a better customer experience, a mattress in a box like Casper instead of an awful experience in a store. And then number three, there'll be some innovation around the quality. The product will just fundamentally be better, like it'll be putting less pollutants into the environment. So that's kind of the trifecta that I look for. Some brands lean more into one versus the other.
When we talk about retail, people often focus on the experience, that now retailers have to provide something in that line. Are you seeing that for startups as well, or is it really the ones that can fill that niche, the best and the quickest and the cheapest are the ones that are going to succeed?
Well, 100% I think experience is really important. If you look at, going back into the history of these D2C brands, it took them a while to embrace offline, for example. If you're Warby or Bonobos, Away, the luggage company kind of was offline right out of the gate. So I think the brands realize now they have to have experiential spaces where customers can touch and feel, they can discover, they can see the employees. Some of them even allow you to come into the headquarters and see the CEO, working at his or her desk.
Do you feel like you're seeing a lot of great ideas right now, or do you feel like it's a thin pipeline?
No, I think there's a massive number of ideas, and some of the things you talked about earlier, there's a lot of money floating around chasing these ideas. So even mediocre ideas, I think, are getting funded sometimes.
So any issue that you have will get solved by someone out there, or it will be shortly. Thank you so much, David Bell of Idea Farm Ventures. And we can't go on a week this show without talking about WeWork. SoftBank is said to be taking control of the company as part of a rescue financing plan that will see founder Adam Neumann depart the company's board. Neumann is expected to sell a little under $1 billion of stock to SoftBank. WeWork, which scrapped a planned IPO in September, had been considering two separate rescue packages from SoftBank and JP Morgan to keep it from running out of money as soon as next month. The deal values the office-sharing startup at about $8 billion versus $47 billion, which was its latest valuation in January. Coming up, this week's power player, Randy Schwimmer from Churchill Asset Management. He tells us why the middle market has done well in 2019.
not subject, generally speaking, to the whims of what's going on with rates or trade or tariff concerns and headline risk. And so the private markets and middle market in particular has actually weathered pretty well a lot of the volatility that we've seen this year.
I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now time for Power Player, our look at some of the most notable names in private markets. Well, with so much focus on the leveraged loan market, I got a chance to catch up with Randy Schwimmer, who is head of originations and capital markets at Churchill Asset Management. We started out by talking about signs of stress that we've seen in public loan markets, where retail investors and CLOs have been buying less of the debt.
What's happening is obviously investors are taking a closer look at each of the issues as they come out and focusing on ratings and so forth. But with the lack of demand coming in from these two sources that we talked about, everybody's backing up in terms of what's the largest deal that can get done in this market. And so in some cases where you see fairly good quality deals coming to market, whether it's for the rating or for size or leverage, those deals are not getting done as easily as they had been 6 months ago.
So are the technicals the same in the middle market?
Very different. So the middle market is a closed system. So money, instead of coming in and out of the middle market, is really dedicated to folks like ourselves, long-term capital from investors who want a certain amount of yield, premium yield to the broadly syndicated market, and better structures, so covenants and things like that. And so that middle market is a closed system and therefore is not subject, generally speaking, to the whims of what's going on with rates or trade or tariff concerns and headline risk. And so the private markets and middle market in particular has actually weathered pretty well a lot of the volatility that we've seen this year.
Although, how concerned are you about the amount of money in this closed system that has come in that perhaps is propping up valuations to points where it doesn't really make sense longer term?
So on the private equity side, think that that's separate from private credit. So private equity, there's probably about a $500 billion overhang of dry powder, and that's been consistent over the last several years. There's a lot of money coming into private equity space because they're good returns and people still feel there's value there, less so in private credit. And interestingly, the dry powder in private credit now, instead of being $500 billion, is probably about $100 billion, and so you have still plenty of opportunities for folks like ourselves to invest wisely.
So where are you sourcing right now?
We're actually sourcing directly from the private equity fund. So I have a team of folks who are out there every day. They're out there now looking directly at private equity funds, and in a number of cases, probably 70% of the deals that we look at, they're coming from sponsors where we actually have an LP investment interest. So we're essentially a client to a lot of these sponsors. So when we're going to them, we're not just going to them as somebody looking to help them provide capital and get their deals done. We're actually going to them as a customer who's investing in their funds, and that's a great opportunity for us to expand our share in the overall market.
So the more volatility that we see in broadly syndicated loan markets, are you seeing an increasing amount of deal issuance in the private markets, in the middle market space?
Yes, so direct lending is actually taking share from the deals that would normally go the syndication route. Because think of it, if you're a private equity sponsor and you've got a deal deadline and you're saying, hey, I could either go to a Churchill and get my deal done, or I could go the syndication route, which means I've got several weeks to present to investors. I've got to take my management committee away from time that they're spending running the company and run this syndication process. No, I'd rather de-risk it and go with someone who can do the whole deal for me.
But do they have to pay a higher rate in order to access the middle market?
No, and that's one of the beauties of our market, which is pretty efficient. What we can say is actually, we'll get you a good rate, and in fact, if you go to the syndication market and fail, the rate that you'll end up getting in that market will be significantly higher because everybody will think your deal is tainted.
I just want to get your sense of some of the media coverage of the loan market over the past couple of years. There has been a lot of concern and criticism about the terms, about the way that investors really don't have protections, about some of the deterioration in credit quality, the loan-only types of structures. Do you think that these accurately reflect expect growing risk in the loan market, both broadly syndicated and beyond?
Well, I think certainly in the liquid market, there's been an important focus on covenant light, which is essentially a bond-like lack of a maintenance covenant and only incurrence tests, which I think, in my opinion, should be in the bond market, not in the loan market, particularly in the middle market, which typically doesn't exist in. I think the focus on that has been appropriate. I think some of the comments about risky loans in leverage lending tends to focus on the worst excesses, which we understand is important to avoid. But leverage lending as a general matter over the last 30 years has been actually a pretty safe place to invest.
That was my conversation with Randy Schwimmer, head of originations and capital markets at Churchill Asset Management. That leads me to another power player in the news. Dan Ivison, PIMCO's group chief investment officer, made a bullish bet on beaten up energy credit with his own money. SEC filings show he personally invested $3.2 million in the PIMCO Energy and Tactical Credit Opportunities Fund. PIMCO Energy, which launched earlier this year, is the first closed-end energy fund to focus on debt rather than equities. Coming up, one of the hottest commodities in China right now is a pair of sneakers. We tell you why Nike shoes may be a better investment than the company's stock. This is Money Undercover. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now to sneakers. Yes, sneakers. Sneaker collecting went mainstream in the United States after Nike launched Air Jordans in the 1980s. Now it is spreading globally, with one estimate putting China's sneaker resale market over $1 billion in value. Joining us now, we are so happy to say, is Bloomberg's Matt Townsend. Matt, let's just talk about how big this market is for reselling sneakers.
Yeah, in the U.S., it's roughly a $2 billion market, and China's already to $1 billion. So that shows you how fast it's growing. The potential for China is huge, given that the population and just the demand for, Western brands and brands like Nike and Adidas. So
if you have a pair of old sneakers in your closet, you can just haul them out and put them on a platform and make a lot of money?
Well, they got to be special sneakers. So these are sneakers that are either, maybe they're somehow tied to an entertainer like, Kanye West, or they're limited edition, or they're really old, and so there's not that many of them left in usually pristine condition. So this has basically just become a huge market. Like, think about a stock exchange. You buy a product, you buy a stock, you try to sell it for a higher price. That's what they're doing with sneakers. In one case, in our story, we point out one pair of sneakers went up 6,000% and was sold for $10,000. One pair of sneakers.
Okay, so who's buying? Is this institutional money, or is this individuals who are just really passionate about sneakers?
At this point, it looks like a lot of individuals, teenagers, kids. I mean, if you go on social media like TikTok.
Wait, teenagers can afford a $10,000 pair of sneakers?
Yeah, well, that's an extreme case. Well, that purchase in China was probably from someone with a lot of money. I'm not saying it was a pension fund or something like that, but it was probably someone that had already made a lot of money doing this. But this is sort of the new way that kids see how to make money. You don't necessarily need to go to college or get a job. It's like you can just buy sneakers cheap and sell them online for a lot more money. And this is a completely legitimate way to make money now.
So which online avenues do they use?
Yeah, so the big one is called StockX. And actually, earlier this year was valued at $1 billion. It got more money. These are venture capitalists putting money into an online sneaker stock exchange. And some other ones, I think another one sold for $250 million earlier this year. So this is, there's money going into these, venture capital money, with the idea that someday they're going to either sell the company, or maybe it'll go public. Who knows? I mean, it's not too far-fetched to see one of these companies becoming a public company.
And is it Nike in particular, or how are other brands trying to get their sneakers in this?
It's everything. I mean, it can be even offbeat stuff that you don't even think about, like old Reeboks and things that maybe aren't even popular anymore, but just have that value of being old, or somehow connected to something cool that back in the 80s and 90s. So yeah, it's a booming market.
So you don't have to go to college anymore, just resell sneakers. Thank you so much, Bloomberg's Matt Townsend. And speaking of international markets, ratings are out for the world's best pension funds. Topping the list this year, the Netherlands and Denmark both earned an A grade from the Melbourne Mercer Global Pensions Index, which uses 40 metrics to assess global pensions, not, I am assuming, how many sneakers they have bought and resold. Time now for this week's Billionaire Beat, and we are talking Brexit. Bloomberg's Tom Metcalf joining us now from London to discuss how Britain's richest are affected by the political high stakes. So can you give us a sense, Tom, who has the most at stake with respect to the Brexit outcome, just with their personal fortunes?
Well, Britain's richest man is a guy called Jim Ratcliffe, and funnily enough, he's actually a massive Brexiteer. So he was out there in public going, hey, we really need to do this. And funnily enough, over the period of the vote, his fortune has absolutely shot up. He's now got a fortune of about 18 billion, I think, and that's up from 6 or 7 at the time of the vote. And then the other guy just below him is another Brexiteer, a guy called James Dyson. You probably know him through his vacuum cleaners. And again, he's seen his fortune absolutely vault over the period.
And is the idea here just that as the pound has gained on speculation that there would be some sort of agreement, their holdings too have changed, or is it something else with respect to their assets?
Well, certainly in the short term, when you have sort of that news, it looked likely a deal was happening. That helped anyone denominated in pounds, their fortunes to rise on our index. But the funny thing is, for both Dyson and Ratcliffe, these guys, despite being supporters of Brexit, they're not really affected, nor are their businesses, by such a national concern. I mean, Ineos, which is Ratcliffe's company, is global. So what happens in Britain's political scene doesn't really impact it. And similarly for Dyson, and now, you know, the US market is absolutely huge for them, Korea. So these guys are kind of talking about, you know, getting involved in this national debate, but they're able to be sort of inured from any of the financial consequences of it.
So who's been hit the hardest?
So it's the people who can't move their assets out of the UK or have, you know, very UK-focused businesses. So the person hit hardest was actually the Duke of Westminster. He lost $1 billion straight off the bat when Brexit was voted through. He has most of his fortune in London property. And as you can probably imagine, that has not been a great asset class, given the uncertainty swirling around London and the rest of the UK, given the vote.
Thank you so much. Bloomberg's Tom Metcalf. And speaking of big money, it's time for this week's big number. We're looking at private real estate fundraising in the third quarter. The number is $121 billion. According to Preqin, that represents what has been secured so far in 2019, keeping the year on track to break the annual fundraising record. And certainly some people are going back into London saying perhaps they can pick up some real estate on the cheap if Brexit does manage to avoid being absolutely disorderly. Does it for us. Remind you can watch us each Tuesday at 1 p.m. New York, 6 p.m. London, and 1 a.m. in Hong Kong. This is Bloomberg.